legendary investor, Stanley Druckenmiller, speak about his views on the market, what the government's up to, many other various things. Already, let's listen to legendary investor Stanley Druckenmiller.
You're salivating over, Joe.
I'm going to let you do it. You go in the sequence you want. They introed it like that. Go ahead.
So at this point, in 2021, in the second half, all right, interest rates on the 10-year are like 1.1. On the 30-year, despite having been corrected in a tweet, and I was right to be corrected, it was not 70 basis points under the Biden administration. It was, let's use 1.1. That's a more reasonable estimate. By the way, the tweet that corrected me on the 30-year is incorrect. It was trading at 160 as a low that period, and it was under 1.8 plenty of the time. The tweet that said that Treasury has never managed the maturity of the debt is also historically incorrect. As most of you probably know, the Treasury Department suspended 30-year auctions in 2001 because term premium was high, the yield curve was steep, and they thought it was a useless use of money, so they were reinstated 5 years later. One more thing on this issue. In terms of...
Learn something new every day, right?
The maturity of the debt, Treasury will have you believe, and the tweet used this, that the maturity of the debt is 72 months. That conveniently leaves out $8 trillion that is funded overnight in the repo market. That's the Fed balance sheet.
How much overnight?
$8 trillion Fed balance sheet. We at Duquesne use the consolidated government debt because we're looking at what the taxpayer is on the hook for. In fact, when the Fed was making profits, they remitted the money to Treasury. So why you would leave out, in terms of government debt, $8 trillion, under that, the maturity of the debt, which was 3 months pre-COVID, is now 57 months. So the statement by the Treasury Department and others that the maturity of the debt has increased since pre-COVID is absolutely incorrect. All right.
That's like we created 12 million. That's the same kind of...
The question I have, putting aside the Yellen...
I want to get to his answer, though.
No, my one question is, do you believe that there would be a market for selling much longer-term duration bonds? Either many more...
He's like, I want to get to his question. He's like, yeah, but I have a question.
Or going up to 50s or 100s. And the reason I ask is that was the implication, I think, of what you were saying. I made a bunch of calls yesterday, and I know that I started reading all these studies and other things that folks inside the Treasury Department, including under Mnuchin, looked at doing that 50-year. In fact, I looked and found an interview that Mnuchin had done with me at a DealBook thing years ago, where he wanted to do it, but then realized or thought that he couldn't do it because he didn't think that there was enough of a market and that it would actually, it would sort of pervert the rest of the market otherwise.
Currently, no. I think that market would be very challenged in the current environment. Don't forget COVID. We were spending the federal government was 20% of GDP in spending.
Right.
It's now 25% of GDP. As outlined in the Wall Street Journal editorial this morning, my father told me, if you're in the hole, stop digging, Stan. So I was actually happy to see when the announcement, the support for Ukraine and Israel, $106 billion, I was waiting to hear what the offset was going to be. Was it going to be entitlements? Where were the cuts going to be? And the next thing I knew, 2 days later, there was not only no offset, there was $56 trillion in emergency spending. I have kids, I have grandkids. Child care is not emergency spending. It's a priority that maybe should be on the table or not, but we are spending like drunken sailors. Okay, so
do you agree with the House Republican plan, which puts forth spending for Israel but cuts it in the IRA through funding to the... Is that an appropriate offset in your mind?
Becky, I want to go after entitlements. It's where the money is. And at some point it's going to happen. I'm going to give you some numbers to tell you why it's going to happen no matter what. Anyway, getting back to the question, and then I really want to leave it, because that's something that's in the past. We can't fix. We missed a once-in-a-century opportunity. Let's just not.
Everybody else, that's your point. Everybody you know, extended mortgages.
No, so here's the thing. Yesterday, Steve Leisman said, I wanted Treasury to trade like a hedge fund. Okay? I do not want Treasury to be trading and messing around the maturity of debt. All I'm saying is in 2021, Janet Yellen, okay, and Mnuchin before her, we spent $5 trillion. The idiots were lined up out there, wild to buy Treasury debt at 2%, whatever you want to call it. Let's not play gotcha on this one, okay? Or 1.1%, with nominal GDP growing at 10%. Right. 10%. Okay, so look, it's not like it took Stan Druckenmiller to figure out that you're at like a 700-year low in interest rates. Okay, nominal GDP is growing 10%. That the risk reward of issuing debt at 1.1% in the 10-year is off the charts. How off the charts was that risk reward? 80% of American households, 80% refinance their mortgage. They lengthen the average maturity of mortgage debt from 3.5 years to 8 years. As a consequence, it's going to take 5 years for that maturity to go up, to get back to like 4.5. So it's just huge in terms of what they saved.
Yeah, I mean, I can't disagree with anything the man just said. He made a lot of great points, and yeah, sometimes you just got to let a man like that just speak and try not to interrupt him. Let him do his thing. You know, I think he brought up a lot of great points. Elf Beauty reported another A-plus quarter. The quarter was shocking. Okay, $215 million in net sales versus $122 million. Cost of sales only went up to $63 million versus $42 million. So gross profit went to $152 million. Selling general and administrative expenses, considering how much revenue growth, they actually kept that pretty in check. Operating income went to $40 million. Net income went to $33 million. And their EPS almost tripled year over year, right? Absolutely shockingly great numbers. I listened to a conference call. I walked away as optimistic as ever in this company. They beat every single quarter. Like, they beat, I think, 11 straight quarters. If I recall, I think it's 11 straight quarters they beat on revenue and EPS. Shocking. It's nearly 3 years of straight beats. Think about that for a moment. Like, how do they do it? How do they freaking do it? Okay? And so I looked at those numbers, right? And I'm also thinking analysts are way off on their numbers. They're too low. They're too low on all their earnings per share numbers. They're too low on their revenue numbers. ELF beats quarter in and quarter out, and analysts are too low. And so if you look at the forward Ps, they're not accurate. They're not going to be accurate. We're trading, based upon this fiscal year's numbers, 35 times. That's not going to be accurate. It's way lower than that. Supposedly for next year's numbers, we're trading at 30 times. That's not accurate. We're going to be way more profitable than analysts have us here, okay? So none of those numbers are accurate. And even if, let's say hypothetically, this is the way I was thinking about this. What if we were trading at actually a 30 times next year's numbers, okay? The way I thought about this is for a company that's been growing revenues 60, 70, 80%, and for a company that's, nearly tripling up their earnings per share on a year-over-year basis, the bottom line is, folks, ELF is a steal freaking deal. A steal deal, okay? Is the biggest chopper in the world coming or what? What is this thing? What is this chopper? What is this thing? Holy smokes. Now that's a chopper. Whoa. Now that's not one of those little choppers. That's a big boy chopper right there. Holy smokers, that's no dang jokers, okay? Now, obviously I have my 1,000 shares of ELF on a shelf already, right? And I feel great about this stock because if there's a recession, it does phenomenal. If there's inflation, it does phenomenal. If there's a good economy, it does phenomenal. It doesn't matter. Like, there's very few stocks in the stock market you can say, if there's a recession, high inflation, good economy, bad economy, that like they would be great in all those environments. ELF's one of the very few stocks, and it doesn't matter the economy. It does well no matter what. And as they've proven out, right? They've done well in a recession, they've done well in inflation, and they've done well in a good economy. So the conclusion I came to is I don't own enough. The bottom line is I don't own enough ELF Beauty. And so what I went ahead today and did, especially given the fact that this stock wasn't up 20% plus like it should have been, I went ahead and bought another $20,000 of ELF Beauty here today. I bought that in my Ally account, and I said, I think ELF's going to be a money printer into year end. I think it's going to be a money printer for years to come in the future. And so it's hard to buy a stock when you are up 1,200% plus on that stock. But at the end of the day, it's all irrelevant. All that matters is ELF a money printer over this coming years? Am I buying an undervalued stock? And the bottom line is it's very undervalued, extremely undervalued. And I think the stock's going to be a huge money printer. And so As tough as it is to buy a stock when you're up that much on it, I had to go out and do it. And I went ahead and bought another $20,000 worth. And it's a stock I can hold regardless of what happens in the stock market, regardless of what happens in the economy. It's all irrelevant. This company is one of the very few that they tear it up regardless, okay? And you can't say that for many companies, all right? But Apple, I'm seeing some baloney out there, okay? Top news, Apple now has $162 billion of cash on hand. And I'm like, it's baloney. It's not accurate. It's literally not factually accurate. And you could fact check this easily. Apple has cash and cash equivalents of $29 billion, 29.9, right? So just under $30 billion of cash and cash equivalents Apple has. That's what the headline should be. Now, if you want to add up their marketable securities and their long-term marketable securities that are things that are dated over 1 year into the future, then you can get to that number that you want to get to 160. But that's just not, to say they got $160 billion of cash, it's not accurate, actually. Okay? So that was something that was very important. Also, what is accurate is they have long-term debt of $95 billion in their balance sheet now at this point in time, right? Which is over 3x what they actually have in cash and cash equivalents. And another thing when it comes to Apple is they have one of the most shocking numbers in regards to Apple, $62 billion in shareholder equity. That's horrible. Horrible. We're talking about a company that has what is Apple's market cap here? $2.78 trillion market cap. $2.78 trillion market cap, and all the company has in shareholder equity is $62 billion. That's like nothing. Literally like nothing. So it's amazing because I've watched Apple's balance sheet, folks, and this is very important, okay? I've been tracking Apple since I got in the market. I have watched over the past 5 to 8 years Apple's balance sheet, despite them bringing in so much profits, deteriorate rapidly to the point where they only have $62 billion in shareholder equity on a nearly $3 trillion market cap. Why has this happened? You got to ask yourself. Why has this transpired when the company's brought in so much in profits over the past 7 years or whatever? Why has their balance sheet been deteriorating? The reason being is they're spending so much of their money, almost all their money pretty much they're bringing in, and sometimes they're even taking out debt, to essentially do dividends and share repurchases. Which you might say, well, Apple's bringing in so much money, you might not care about that today. What if Apple ever runs into hard times in the future? What if those iPhones aren't quite selling the same down the road someday, right? What if those iPhones are disrupted someday? What if, this or that happens? Like those are things to consider. And so Apple's just, instead of piling cash and really building out their balance sheet, they're actually destroying their balance sheet. And so I just think that's some food for thought there, folks. That's I used to look at Apple's balance sheet and think, and this was even 5, 7, 8 years ago, and I used to think, man, this is one of the best balance sheets out there. Not anymore. Not with that big debt load and with that little shareholder equity, folks. It's not what it once was. And so, especially when you consider how large the market capitalization's gotten now at this point in time, it's pretty darn shocking. I mean, really darn shocking. Now, the stock's moving down after hours, down about 3% or so, roughly. And there's really two components of this. This is a smaller reason, but they're actually a business in decline. Now, this is several quarters in a row. Their business is literally declining at Apple, which is pretty shocking to see. Their product revenue went from about $71 billion, roughly, in this quarter last year to $67 billion in this most recent quarter. The other thing that's interesting is this quarter ended September 24th versus this quarter ended September 30th, which is even more troubling because that means this quarter actually didn't get an extra week of iPhone sales where this quarter did, right? So that's something to take into account. So that's important, man. That's important. I mean, their product revenue, and remember, this is like iPhones and Macs and Apple Watch and all those things, dropped almost $4 billion with one less week, like one extra week. That's surprising, okay? Now, services is a bright spot. Services is saving the business model right now, okay? And so net sales were only down, we can call it $600-700 million or so for the company, but it's really because services came to save the day, okay? Now, in terms of cost of sales, they're kind of keeping things roughly in line there. Gross margin was up for the company on a year-over-year basis. R&D, they are spending, more on R&D, which they kind of have to do, right? I was really shocked to see this number. Selling, general, and administrative, they actually were down almost $300 million year-over-year. That was pretty surprising. Operating income for the company came in nearly $27 billion roughly, and EPS came in very healthy. So that's why I gave them a C+, because their bottom line numbers are very healthy. But it's obviously not good to see how bad of a spot the hardware business is right now. And, I don't feel like these headlines are doing enough justice. I don't think we should be talking about, Apple has $162 billion, which they don't, in cash. I think we should be talking about Apple's business is deteriorating rapidly in the hardware space. Like, these are not small numbers, folks. Nearly $4 billion year over year. And you got this extra week. Like, that's crazy. That's crazy. I think that's important. Now, the real reason the stock started to go down after hours is the bad news we got on the conference call. And Luca, the CFO of Apple, basically said that they're expected to do roughly inline numbers with last year. Now, that's a huge problem. The reason is analysts had the company growing revenue about 4.5% roughly for this next quarter. So the fact that they're talking about they're only going to do a number roughly in line with last year is it's not good, folks. It's not good at all. I can tell you that. Not good at all. Now, I actually texted a friend this. I said, the stock's holding together well despite the weak guide. I think everyone just cares about the services number now. That baby will just keep growing and likely keep growing for many years to go in the future, which is, what I believe will play out. Like, services shouldn't stop growing. Like, if that ever stopped growing, then it's a whole different ballgame for Apple, right? I said products revenue will eventually likely come back. Apple either has to launch a banger product, like a banger iPhone eventually, or the consumer's got to get in a better spot. One of those, eventually one of those two scenarios will likely play out, and so that's good for Apple. But, the business is in decline, and it's now several quarters, and it's actually seemed like it's gotten worse recently, which is a little worrisome. Stock market last week, stocks this week, and what a turn. I mean, what a turn from where we were at last week at this time versus where we're at now. It's been a pretty quick turn. Now, in regards to this, okay, big turn in the numbers bearish going into the last few trading days here. So this was as of November 1st. Over 50% of market participants are now bearish on the stock market for the next 6 months. That's a big number there. Anytime you go over 50% bearish, it's very rare territory. It doesn't happen that often. And when you hit that, you almost know it's like a perfect contrarian indicator, where essentially usually when you're above 50% bearish, usually you're within a market bottom, and usually the market's going to perform pretty well in the future months, if not future years. That's usually what happens. And so to take you back a few time periods in the past to kind of illustrate this point, okay, this was March 5th, 2009. This was a week before the stock market bottomed. Literally, the stock market bottomed. We hit the most bearish number I've ever seen in the history of the AAII investor sentiment, which goes all the way back to the 1980s. So it's not like this is a new metric. This is something that goes back to the 1980s, okay? And that week, we hit 70% of market participants were bearish for the next 6 months on the stock market. Obviously, we had a tremendous next 6 month rally from basically about that week or the week after, all the way through October, November of 2009. It was an insane bull rally. Like, people couldn't even believe it. And a lot of people were in disbelief at that bull rally, to be honest, because they're, went into it so bearish, and they're like, the economy is still so bad. Look at how high unemployment is. People are pointing out all the negatives. Foreclosures are still happening in mass, short sales. But yet the market went on this beast rally, right? What about what happened last year? Check this out. This is going to blow your mind. Here we are looking at this same sentiment survey, but this was last year. Now remember, the indexes in all those tech stocks pretty much bottomed out in October of 2022, right? After they had all been obliterated. Now, if we go back to these numbers during that time period, look at this. Between 50 and 60% of market participants were bearish all at that time. And they were, remember, this is a survey to how bullish or bearish you are for the next 6 months. Are you bullish on the market the next 6 months, bearish, or are you neutral, right? And so here you had all these market participants bearish for the next 6 months. And what happened over that next 6 months? It was a ripper rally. And especially in regards to all the stocks that people thought were going to keep going down. Remember all the predictions? Tesla's going to $50 to $60 a share. Remember all those, right? I mean, gosh, remember all the people that said Meta was still not a buy at $88 and it's going down to $40? I still got the comments on my YouTube channel. Meta's going to $30, $40, $50. Now it's over $300 today. And remember how many people were loading up on put options and short sales in the fourth quarter of last year, thinking we're going to get guaranteed recession the first half of the year. Remember, everybody and their grandma was calling for a bad first half of the year, right? And this sentiment goes to show you exactly how people felt. And so usually, It's a contrarian indicator. So when over 50% of people are bearish on the market, it's usually a pretty good sign that it's actually an opportune time to be buying stocks, buying and buying and buying, and don't stop buying. No, the market has an interesting phenomenon going on that's very, I would say, bullish for us overall here, okay? So everybody looks at the Dow Jones Industrial Average, S&P 500, and the NASDAQ, right? If you go to CNBC on their app, what are the three indexes they show you? Dow, S&P, NASDAQ, right? That's what everybody's focused on. That's what everybody talks about and all sorts of things. I can make an argument that those aren't actually the most important stock market index, believe it or not. They are extremely important. They're what everybody pays attention to. The masses all pay attention to the Dow, which all of us as stock market investors know the Dow is a joke. The way they weight the Dow is just silly. They weight it based upon stock price. It doesn't make any dang sense, okay? It's probably the silliest index, but that's what the masses are all focused on. You hear everybody talking about, oh, the Dow, when if you watch like, any sort of big news media that's not financial news, and they ever bring up the stock market, oh, the Dow was down 500 points. Oh, it was down 1,000 points, up, whatever, okay? The S&P 500 is the most looked at metric usually for general market investors, and the NASDAQ is the most looked at index usually for, let's call it, more sophisticated investors in the market. They're usually looking at the NASDAQ or looking at the Qs in general. But arguably the most important stock market index, if you really want to know what it is, it's actually the Russell 2000. The Russell 2000 is what ultimately, that is the index that can lead, basically can give you signals for what's happening in the future. A lot of times, if the market's about to go through a weak spell, the Russell starts getting hit first before the other major indexes and stocks start to get hit. And all of a sudden, you'll see the Russell dropping and dropping, and people will be like, that's kind of weird. The Russell's dropping. All of a sudden, next thing you know, boom, the NASDAQ drops. Boom, the S&P 500 drops. Boom, the Dow drops. And on the flip side, the Russell can lead you out of bad scenarios. And so one of the things you want to look at if you're trying to gauge, like, are we actually going into a bullish market or is it still bearish or these sorts of things? One of the things you want to look at is the Russell, how it's doing overall, and you want to see, what is that? What is that noise? I don't know, man. Hearing noises. I'm going to smash somebody in the head with this 7-figure award. They try to come up in here. That's all I'm going to say. Or maybe a 6-figure diamond award straight to the head. Woo, that would not be pretty. It's getting a little scary around here, okay? Alrighty, so Russell 2000, it has had a horrible past 5 years. Down about 14%, up 14% in the past 5 years. That's a horrible 5-year span for the Russell overall. Now, if we go ahead and take a peek at the Russell 2008 through 2000, this is about the end of 2008, through 2018, the Russell did tremendous. And you're in a very healthy stock market overall when the Russell's rolling. When the Russell's not doing anything for 5 years, you're in a very unhealthy market. There's clearly things going wrong in that market, right? A good example of that, if we look at the end of 2006 through the second quarter of 2011, the Russell did about the same that it's doing right now. The Russell was up about, let's call it 11 percentage points or so during that time frame. That's a very unhealthy market. You can get there two ways, right? One could be through a significant crash like we had, obviously, 08, 09. Another way you can get there, folks, is you can go through a market where you're just kind of flattish, right? Moving up, moving down, but you're not really going anywhere. You can happen two ways, right? No different than a stock stagnating over a certain period of time, a 5-year span or something like that. One could be because it crashed huge and then it started to come back. The other could be just it was kind of flatline, and that's what we've been in with the Russell, where it's just been a complete flatline. And you guys know I've been talking about this for, geez, how long am I freaking talking about this, okay? Small caps are insanely undervalued. Insanely undervalued. Right now, this is forward Ps, this is Yardeni research. Forward Ps on S&P 600 small cap are 11.8. 11.8. This backs it up for the past 25 years, basically, in the market. And the only time you could really ever find us trading cheaper than what we've been trading at very recently in the past, we can call it, roughly 2 years, is in the depths of the great financial crisis. That's the only time you can find us trading cheaper on a forward P basis for small caps. So nonetheless, folks, we're in a time period of silliness in regards to small cap land. And the thing everybody's got to understand is you can only stay in these ranges for so long. You can only stay at a super overvalued market or super undervalued market for so long. And eventually, stuff starts to break. And it starts to break to either the upside or the downside. But in regards to an overvalued market, you don't stay there forever. As we saw in the tech bubble, right? Eventually, that ended. as we obviously witnessed in the 2021 market, eventually that ended. These super high valuations, look what happened. They collapsed, right? Super high valuation, super high valuation, super high valuation. It collapsed. And on the flip side, you don't get a long time period usually of down and out. We've been down and out for these valuations for, almost 2 years now. Almost 2 years. That's extraordinarily long. So if you want to talk about some stocks that are due to go on a beast run eventually here, it's the small caps, and everybody's just kind of waiting. What's going on with the small caps, right?